Anyone in shares of stocks like Nvidia, Apple, and Amazon over the last year can tell you returns of 20, 59%, and even 150% are possible. But with those returns comes the stress of a market crash and double-digit losses. Index funds, on the other hand, may not produce the same returns, but it's also without those stomach-churning drops. So which is better for your money, index funds or stocks? Is there a balance between return and risk, and how do you know how much to invest in each? I'm going to explain index funds, how they work, and show you how both risk and returns match up against stocks. I'll then show you exactly how much to invest and how to use both for that perfect balance. Now, an index fund is just a group of investments bundled together, and then shares of the entire group are sold to investors. Buying a share of the fund means you get the returns on everything in that group instead of having to buy hundreds or thousands of stocks separately. And for this, you pay a percentage fee to the manager. And when we talk about index funds, we mean broad groups of stocks like the S&P 500, which is the 500 largest companies in the United States, or the NASDAQ 100, which is the index of 100 largest non-financial companies listed on that exchange. Buying an index fund means you get that broad market exposure. You are the market, and you know you're always going to get that diversification and the return that you can only get from the entire market. You just don't get that from an individual stock. For all the upside returns you might get in a stock, your money completely depends on that one company. We'll compare index fund returns with stocks next, but first, I want to thank our sponsor for today's video, Fabric by Gerber Life. We talk about investing for ourselves and our future on the channel, but just as important is our kids' future. Because your kids can't invest when they're minors, it means it's all up to you to get them started with a UGMA Kids Investment Account. And you can do that in less than 10 minutes with Fabric by Gerber Life. Fabric was designed by parents for parents to make it easy to plan for and manage your family's financial path. With a kids investment account from Fabric, you can start investing in your child's future today. It's all online, and starting with as little as $1 a day can grow into $10,000 plus. And the gifting feature makes it easy to share your child's unique gifting link so friends and relatives can contribute too. The best part is these UGMA Kids Investment Accounts carry special tax benefits. The first $1,250 in income on that account each year is completely tax-free, and the next $1,250 is taxed at the child's rate. That means little or no taxes each year, and the money can keep growing with those compounding returns. Invested funds can be used for education plus so much more, like summer camps, club sports, and when they're adults, for their first home or to start a business. There are no contribution limits and no commission fees, and accounts are SIPC insured up to $500,000. You can learn more by going to the link here, or I'll put it in the description below. Start investing in your child today. Go to meetfabric.com/Joseph. That's meetfabric.com/Joseph. Comparing index fund returns to stocks isn't as straightforward as you might think. For example, here I have the S&P 500 ETF Trust, the ticker SPY, that broad index fund of the 500 largest companies, with a 19% return over the last year. On top of that, we see the two best stocks in the index, Vistra Corporation with a 146% return, and shares of Nvidia up 125%. And then the two worst stocks, shares of Walgreens, WBA, with a loss of 64%, and Albemarle, ticker ALB, with a loss of 58% over the year. And of course, graphing all 500 stocks in the index would give us a chaos of spaghetti between the stocks on the top and the bottom, but you get the picture. For the fund investor, they know they're going to get that middle-of-the-road return. For the stock investor, it's not so easy. Not only do they have to be able to pick those best stocks out of 500 or more, but know exactly when to sell. JP Morgan surveys investors and graphs out average investor returns against broad asset returns, finding the average stock investor made just 2.9% annually over the 20 years through 2020. That is well below the return on the S&P 500 index and only barely beating the rate of inflation. And it's because investors are their own worst enemies. Between picking the wrong stocks and then buying and selling at the wrong times, not only do they get those lower returns than just a simple index fund investment, but they also get all the stress that comes with individual stocks. Of course, none of this means I'm going to stop investing in individual stocks. In fact, there is a strategy that gets you all the upside returns on stocks, but also the lower risk and stress of index fund investing. This strategy helps solve the problems that lead investors into those lower returns, so you only invest in the very best stocks. First though, I want to highlight two index funds you can use with this strategy. First up, the Invesco S&P 500 Equal Weight ETF, ticker RSP. Now, this is my favorite index fund right now and clears up a major problem in the S&P 500, that just a few stocks are nearly a third of the index. Now, instead of holding each stock by company size, like in the index S&P 500, the RSP holds an equal amount in each stock of the S&P 500 index, spreading the exposure out evenly across the index, so you keep that index exposure to the largest U.S. companies, but across all of them. That equal weighting also clears up the sector level problem in the traditional index, dropping tech stocks from 27% of the group to 13%, and communication services from 9% to just 4%, while other sectors get a little more exposure. This fund does tilt your exposure towards smaller companies since they have that higher weight than in the regular S&P 500 index, but even the smallest company here, Fox Corporation, is still a $13.8 billion giant, so this is still a very large cap fund. Even better, because those big tech companies that are overweighted in the traditional S&P 500 index are lousy for dividends, the RSP ETF pays a higher yield at 1.7% versus the 1.4% average in the market index. That's going to give your portfolio the size and financial power of those mega cap companies, the largest in the United States. Then, to add some broad growth, we're also going to be buying the Vanguard Small Cap Index, ticker VB. This fund holds shares of over 1,400 companies with a median market size of $6 billion, which is still pretty darn big, but much smaller than the mega-size $195 billion companies in the S&P 500 index. Stocks here are also much cheaper at just 14.6 times on a price-to-earnings basis, versus 23x multiple on those S&P 500 stocks. So these smaller companies not only have more room to grow for those higher returns, but also give you solid value tilt to your portfolio. You still get solid exposure to those growth stocks like tech in the small cap index fund, where the sector is almost 13%, along with consumer discretionary at 16%. But overall, it's just more diversified across sectors than the larger index. Within those 1,400 plus stocks, you don't have to worry about any one destroying the fund like you would with a crash of the Magnificent 7 in the S&P 500. Here, no stock is more than 0.4% of the fund, so it is much better spread out across stocks. Using these two index funds in your portfolio while still getting the upside return potential of stocks means using what's called the core satellite strategy. Using the core satellite strategy means investing 50 to 65% of your money across index funds and ETFs. It means you'll always earn that no-worries stock market return, along with the cash flow and growth we're talking about with these funds. And that's the core part of your portfolio, the majority of your money in those low-cost, worry-free index funds. Then with the remaining 35 or 45% of your money, you invest in those individual stocks you really like, the ones we talk about here on the channel. You get the chance to pick stocks that are going to boost your portfolio, but the fact that it's only about a third of your money does some amazing things. First, with maybe 3 or 5% of your money in each individual stock, it means you're only investing in maybe 10 or 15 total stocks. That means you're not constantly chasing that next hot stock, spending hours of research on each. You find that handful of stocks you really believe in, and you don't have to watch some Yahoo in a bow tie help you find more. Also, because you've only got 3 to 5% of your money in each individual stock, and so much more in that portfolio of the broad index funds, you don't have to worry about any one stock destroying your future. You're not losing sleep when that one stock crashes and takes your dreams along with it, because you know you're still getting that market returns from the core index fund and growth in those other stocks. Once you get started with this core satellite strategy, just invest a little each month, whatever you can afford to invest while you're still enjoying life. Get started on your kids' future with a kids investment account and Fabric by Gerber Life with the link in the description below. Or click on the video to the right to see how to invest $1,000 for dividend cash flow every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.